we talked last class about redemptions. We're going to continue this class talking about redemptions. Remember that the main issue when you have a redemption, when a corporation's buying back shares of stock from a shareholder, is whether it's going to be treated as a sale or exchange, or it's going to be treated as a distribution. So the way that we determine that treatment is we go through 4 different possible situations where if you have one of these situations, it's treated as a sale or exchange. So the first one was substantially disproportionate. Then we looked at the second one, redemption of a complete termination of a shareholder's interest. The third one, remember, we're not going to really worry about, but that's the partial liquidation. And then finally, the fourth one is not essentially equivalent to a dividend. I told you that of the 4, not essentially equivalent to a dividend, this test right here, this is the most subjective. And in this class, all you need to really worry about is focusing on what the examples that we talked about in class. You don't need to worry about anything else, okay? And we're going to look at those examples today in problem 2. So let's go ahead and continue with our discussion from last class and look at problem 1D because we haven't finished that off. So here are our problems again. We're looking at problem 1 still. And last class we went through A through C. So we went through those already. So we're going to look at D. So in D, we're just focusing right now on this problem 1. So remember, we have 100 shares of common stock outstanding. We don't care about the 200 shares of non-voting preferred stock because for purposes of redemption, we just ignore that. So Blueberry owns 70, Mango owns 30 of the common stock, and again, we can ignore anything about preferred stock, so we can just cancel that out right there. We're also told that the corporation has earnings and profits of $500,000. So that's important because if there's a distribution, it's going to be treated as a dividend because there's a law of earnings and profits. That's why that's important. Now, again, we went through A through C already, so we're going to go right to D. In D, we're told that Fruit Smoothie Corp. redeems 40 shares of common stock from Blueberry for $40,000. And we're told the basis that Blueberry has in her shares of stock. All right. So remember, the way we do this is we look at the before and after analysis. And then we apply our rules. So Blueberry before has 70. Tell me I redeemed. Come on. 70 out of 100 shares. After, Blueberry has 40 redeemed, so Blueberry only owns 30 out of 60. So before, Blueberry owns 70%. After, Blueberry owns 50%. So to get substantial disproportionate, which remember is always the first test we consider for redemptions, to get substantially disproportionate, you got to go through those. Well, there's 3 tests, but in this class, really just 2, because ownership's not going to be different in terms of voting or in terms of common stock. The first test for substantially disproportionate is the after percentage, is it less than 50%? Now notice it says less than 50%, does not say equal to 50%. So that means it fails substantial disproportionate. It fails this test. We stop there at that test. We continue on of our tests. Remember, complete termination, you have to have direct termination of, you can't have any ownership. Well, Blueberry still owns stock. After still owns a percentage. That deals with direct, indirect. Okay? So that's not present. And then again, in this class, partial liquidation you don't have to worry about. So that leads us to our last test, not essentially equivalent to a dividend, also known as, and we'll call it for the rest of today's class, NEED. NEED. Okay? So NEED, this is the fourth test. Remember, substantially disproportionate is the first test. And these are the two most important tests. Substantially disproportionate, you always consider first, and then you go down the list, and you go always do not essentially equivalent to a dividend last because it's the most subjective. So there's really two situations you need to know for this class, for the CPA exam, regarding when not essentially equivalent to a dividend, when it applies. And the first one is the one we're going to focus on here. The first is when you go from greater than 50% ownership, and we focus on voting stock. So in this class, it's going to be just ownership. So that's before. And afterwards, you're less than or equal to 50%. Now notice, in substantially disproportionate, it must be less than 50%. But for not essentially equivalent to a dividend, it can be equal to 50%. The idea is that you're losing control. Before, if somebody owns 70% and now they own 50% and there's only two owners, right? Because now, think about it. Blueberry owns, afterwards, 30 out of 60. Who owns the other 30 shares of common stock? Mango, right? Mango owns 30 shares. Mango still owns the other 30 shares. So Blueberry owns 50, Mango owns 50. So before this transaction, and the best way to think about this when you do not essentially equivalent to a dividend is think about decisions that the corporation makes where the shareholders have to make the decision. I always like to use the example of if a retailer if they're voting on whether they should stop their brick and mortar operations and go completely online. So let's say Walmart or another retailer that's traditionally been a brick and mortar retailer, which has online presence as well, decides they want to be 100% online because they have more growth there and more potential. That kind of decision is something that the shareholders have to make. Board of directors? No. Shareholders. It's integral to the business. So the shareholders here are Blueberry and Mango. Well, if Blueberry wants to close down the brick and mortar stores, well, and let's say that Mango does not, well, before this transaction, Blueberry has the ability, because Blueberry has 70%. So Blueberry has the ability to make that decision. But afterwards, Blueberry only owns 50% and Mango owns 50%. So if one shareholder has 50% and the other has 50% and they go both different ways, no longer can Blueberry make the choice. So you see how that's now a huge impact? Because remember, this whole topic about redemptions is a way for people to bail out money and not get taxed on dividends or distributions. So Congress said that's too good to be true unless economically you actually are giving up ownership. So this is a perfect example of where somebody is actually giving up ownership because they're giving up the ability to vote, or control, I should say. They still have the ability to vote, but to control. So that means that we meet not essentially equivalent to a dividend, and this is going to be treated as a sale or exchange, not a distribution. So we're going to take the amount realized minus adjusted basis, right? And we're looking at what's being received. So we're told that Blueberry receives $40,000. It's right here, $40,000. We subtract away the adjusted basis. So Blueberry is giving up 40 shares. The basis per share is $900. So that's $900 times 40 is $36,000. So Blueberry has a $4,000 Capital gain, if it's held for more than a year, long-term capital, let's assume it's long-term capital, right, which is what Blueberry wants. And the other thing to do, or to note, is that the adjusted basis per share of the remaining 30 shares stays the same, and that's going to be the same $900 per share. Because remember, in a sale or exchange, the basis per share will continue to be what it normally was, or what it was before the transaction, but if it's a distribution, you have to reallocate. Remember that? We did that last class. We did that in A and C. So that's really it. Any questions? Okay. So now we're going to problem 2. Fruit Loop C Corporation creates children's breakfast cereals, has 100 shares of common stock outstanding, which are owned as follows. So there's 4 owners: orange, lime, lemon, and cherry. Now, the corporation has $500,000 of earnings and profits. So why is that important? Because remember, if it's a distribution, we have tons of earnings and profits. That means the distribution will be a dividend. So again, remember what the issue is here. People are trying to avoid dividend. If it's capital gain, return of capital or capital gain distribution, shareholders don't really care because it's going to be treated the same way. Actually, end up being treated better if there's no earnings profits because you get to recover the first portion, all basis, okay? And then anything beyond that is considered capital gain distribution. Versus if you use basis, you subtract away the portion. So they have tons of earnings and profits here. So it's going to be a dividend if they have a distribution. So we have 5 independent situations. So Fruit Loop, and they're all separate situations. Fruit Loop redeems 5 shares from Lime, who is Orange's son, for $5,000. The shareholders are otherwise unrelated. Lime's basis is $900 per share. Okay, so before we go through this problem, to save time, I'm going to go ahead and tell you A, B, C, D, and E, right? Remember, whenever you have a problem on the exam, the first thing to do is determine, hey, which topic is this? Is this liquidation? Is it redemption? Is it distribution? Is it formation? These are all going to be redemptions because you're going to see in every problem it says redeems. And that's when the corporation buys back shares of stock. So when you have redemption problems, you've got to go through the 4 tests, starting with substantially disproportionate, just like we did in problem 1. So you continue with that on the exam. I'm going to go ahead and tell you, and you can go ahead and do this at home if you want. I have a YouTube video online that walks you through this substantially disproportionate. But I'm going to go ahead and tell you in A through E, it's going to always fail. It's going to either be more than 50%, or it's going to fail the second part where you have to be less than 80% times the before. It's going to fail one of those 2. So you can go through and try it on your own. You'll see it fails for all these. A through E, it'll fail. And again, I do it on the video, the YouTube video, if you're interested in checking your work. But they all fail. That test. Test 2, they all fail because they all have direct ownership afterwards. Test 3, we're not going to worry about, right? Partial liquidation plan. Not going to worry about that. You just need to know that title. It's an option that you don't even need to know what it is. Finally, test 4. So we're basically going to jump right to test 4 for all 5 of these, is what I'm saying. If we fail test 4, it's going to be distribution. If we meet test 4, it's going to be sale or exchange. So that's all we're going to do in this problem. We are going to go through, again, the amount realized, adjusted basis, and the distribution, and reallocating the basis and all that good stuff we did in problem 1. But, again, I'm saving you time. None of these meet substantially disproportionate. Again, if you had this on the exam, you'd want to go through that and test that. But I'm going to go ahead and tell you that, and you can go ahead and practice that on your own and check your work on my video that I have on YouTube that's posted in the module. So the first one, A. Let's start with that one. You know what? Let's do some crazy stuff here. Is this the one? There we go. Hey, where'd you go? So here's our problem again. So I basically cut that out and I can now work on problem A over here. Oops. So in A, we're going to do before and after, just like normal. So again, we're always going to just focus on, or we're just going to focus on NEED, the test 4, in all 5 of these situations. And as always, we're going to look at before and after. Before and after. Now, there's one key element to this problem, and I mentioned it last class, and that is you have to worry about attribution. So what I'm saying is, we're told in the problem that lime is who's being redeemed. That's the party at issue. But lime is Orange's son. So that means Orange is a parent of lime. Everyone see that? Okay? Orange is a parent of lime. So if you look at those attribution rules that we talked about last class, I told you need to know the family attribution rules. There's only certain family members you have to attribute. And one of them is your parent. So that means that whatever Orange owns, lime owns as well. So before, we're basically going to look at, if you add up these numbers, by the way, 28, 25, 24, 23, what do you get? You get 100. So that makes it easy. 28%, 25%, 24%, and 23%. That's why I did that. So we're looking at lime's percentage. Before is 25, or number of shares. And we're also adding oranges. 25 plus oranges, 28, equals 53. At this point, you want to get your calculators out or use your calculators on your phone so you can practice for the exam. After, okay, that's 53 out of 100, by the way, before. Keep in mind the number of shares that are outstanding. It's still 100. After 5 shares have been redeemed by the corporation. These are all separate alternatives, A through E. So we know it's going to be over 95 shares. So it's going to be lime's 25 before minus the 5 redeemed. That's 20 plus orange is 28. What does that equal? 48. What's 48 over 95? That's right. $50.5%. So there's 2 situations under not essentially equivalent to a dividend rules you need to know in this class. The first one is if you go from more than 50%, which we have 53% here, to less than or equal to 50%, that's going to be viewed as you lose control. And that will be viewed as not essentially equivalent to a dividend. Okay? Unless you already meet one of the other tests, like substantially disproportionate. So they're going to more than 50%. Unfortunately, this is going to fail NEED. So remember I told you last class that if your ownership afterwards is more than 50%, you're never going to get this sale or exchange treatment. It's always going to be a distribution. Because you control before and you control after. Everyone see that? So that means it's going to be treated as a distribution. If it's treated as a distribution, that means since we have $500,000 of earnings and profits, right, we have enough EMP, it's all going to be a dividend. So it's a dividend of $5,000. And finally, the adjusted basis changes per share. The way we calculate that is we're going to take the adjusted basis in Lime stock before, which is $22,500 given to us. We're going to divide that by the new number of shares, which is 20. How much is that per share? What's 22,500 divided by 20? 1,125? Thank you. So $1,125. So it went up from $900 to $1,125. And that is all you have to do in this class for purposes of determining the consequences of that transaction. There's more things that it affects in practice, like earnings and profits of the corporation, all that stuff. Of course, well, we know. If it's treated as a distribution, you go through the four-part checklist. The thing is that it's cash, so we go through step 1 and step 2, no consequences to the corporation. Step 3 would be, okay, we have enough earnings and profits. We have $500,000, it's a $5,000 distribution, it's all a dividend. We just did that, right? So that's easy. And then finally, step 4 is you have to adjust the accumulated earnings and profits for next year. So that's the only thing we're not doing that you could obviously do understanding the 4 steps. Yeah.
How come, like when we're determining the new adjusted basis per share, how come we don't take into account the father also?
Because we're just asking what is the basis that Lime has in his stock, in the 20 shares. But the Orange, that basis, whatever Orange had in stock, stays the same.
Okay.
So technically, if you're looking at overall, it would increase overall, but we only focus on Lime.
All right.
Lime is what gets allocated that, because Lime had the distribution, the $5,000 distribution. So we focus on attributing just for ownership percentage. That's the only thing we have focus on for. We don't attribute like their basis together or anything like that. Mm-hmm. Okay, now we're going to do B. In B, we're told that 5 shares are redeemed from Lemon, who is Orange's daughter, for $5,000. So now we're looking at Lemon and Orange together. Again, each situation is separate. So we do the same thing we just did in A. Remember, we're doing NEED. We look at before and after. So before, Lemon has 24, Orange has 28. We add them together. That equals what? 52%, or 52 over 100. After, Lemon has 19 shares because 5 are redeemed, plus Orange is 28. That equals how much? 47 over 95. What's that equal?
49.4.
Exactly. Thank you, Carolyn. 49.4%. So that's less than 50%. So if we go from 52% to less than 50%, the tax law, so this is where you got to pay attention. For this test, the tax law says not essentially equivalent to dividend if it's less than 50%. If it's less than 50%. So this is going to be treated as a sale or exchange. Excuse me. We do amount realized minus adjusted basis. So we're told the amount realized is $5,000. The adjusted basis given to us in the problem is $900 per share. So times 5 shares is $4,500. So the $500 capital gain, and the adjusted basis per share is the same as before. So it's $900. Now, this is what you want to put in your notes. If it's less than 50%, we don't care about the number of owners. We don't care. Could be 2 owners, could be 10 owners. The tax law seems to suggest, and we're going to focus on this in this class, and they do on the CPA, that if you go from more than 50% to less than 50%, not equal to, less than, you're good. But what you're going to see in C, so we're going to go C now. I just want to scroll. I guess you have to lock those. Still learn this. So in C, we're told that same problem we just had before, but Lemon only has 4 shares. So if we do before and after again, let me rewrite that. It's sloppy. So before, we can just look up what happened above. It was 52%. That didn't change. This is still a similar problem. The only difference is that we go from 4 shares being redeemed to, 5 to 4. So now after Lemon owns 20, right? 24 minus 4 is 20. Plus Orange is 28. That equals 48. 48 over 96. Guess what? That equals 50%. So now we go from 52% to exactly equal to 50%. Exactly equal to 50%. So the tax law, this is a very specific circumstance. The tax law says if you have 2 owners, like we had in problem 1D, 2 owners, and you go from more than 50% to equal to 50%, it's a NEED sale or exchange. But we don't have 2 owners in this problem. We have 4 owners. We have 4 owners. We don't know. The tax law is not clear about this situation. And the reason why is because if you have, think about our example earlier, blueberry and mango. One person clearly doesn't want to give up the retail operations. In our example earlier, the brick and mortar retail versus online. But the other person does, right? Before the transaction, if the person that controlled the stock had 70% blueberry, whatever blueberry wants goes. When you have two people that disagree. Afterwards, if they both disagree, they're at a stalemate, right? Because they have 50-50. But if somebody controls, let's say, okay, orange and lemon before, together they have 52%. And they want to close down the brick and mortar store and go all online. Well, whatever, if they want that, then they get it because they have more than 50% ownership. And let's say that Lime wants to continue with brick and mortar and Cherry is on the fence. So in that case, the other two owners, one's on the fence and one is adamant against orange and lemon. Well, if orange and lemon go down to 50% and Lime still, again, doesn't agree with what orange and lemon want, but Cherry does, Cherry might be influenced by orange and lemon to agree with orange and lemon, so it makes it different than when it's just two owners, where it just be, again, blueberry versus mango. You don't have the ability to persuade anyone else. Does everyone see the difference? So the tax law harps on that. When you have two owners and one person says, hey, I don't want this, the other person says, I do, and you're 50-50, it's never going to happen. But if you have more than two owners and the group that had more than 50% before, they want something, but then they lose that ability, it's not clear. So I'm never going to give you this type of fact pattern on the exam. This specific one where there's more than two owners, it will only be, if there's two owners and goes 50%, then it's going to be NEED. But more than two, it's another issue. It's tough. We don't really know. Now, on my video, I believe I say that it's treated as a distribution, just because we don't know. Okay? I might say it's a redemption, or sale or exchange. My apologies, sale or exchange. But really, the answer is we don't know. And I wouldn't test you on it. If it was treated as a distribution, let's say it is. Let's say it ends up getting treated as a distribution by the courts or the IRS or whoever, right? If it's a distribution, it's going to be $4,000 distribution. We have enough earnings and profits, right? We have enough E&P, so it's going to be a $4,000 dividend to Lemon. The adjusted basis changes per share. It's going to equal the 21,600 divided by the new number of shares. There's now 20 shares. What's 21,600 divided by 20?
1,080.
1,080. I'm pretty sure on my video I have this treatment distribution. There's also a quiz question. That's why I went with that. So if you have the quiz later, follow this or whatever's on the video. Okay? Any questions on that one? So, A through C focuses on the first factor, first element of not essentially equivalent to a dividend, which remember is you go from more than 50% to less than or equal to 50%. That's the first aspect of not essentially equivalent to a dividend. There's another aspect. And the second aspect is what we're going to do in D. In D. Okay, so let's look at D now. So again, remember and normally you'd go through step 1, 2, and 3, but for sake of time, I'm telling you that number 1 fails. Again, you can test it later. 2 fails. 3 we don't really consider this class, but that fails as well. So we go to number 4, NEED. So for NEED, we talked about when we go from more than 50% to less than or equal to 50%. And if that happens, we just explain through A through C, and that's all you need to worry about in this class, A through C, how that works. There's a second element. So let's just see what's going on here. And remember, we always still do the before and after. So in D, we're told that the corporation redeemed 7 shares from Orange. All the shareholders are unrelated, so we don't have to worry about indirect and direct ownership like we did before in A through C. And we're also told the basis Orange has. So all we're doing here is a simple, okay, Orange owns 28 before, out of 100, 28%. After Orange has 7 shares redeemed, so 21 out of 93. What percentage is that?
22.6%.
22.6%. Thank you. So again, this would fail substantially disproportionate because it's not the less than 80% test. I'm sorry, less than 80% times before. That's what I meant. Sorry. Okay, that's why it fails it, by the way. If you calculate it out, it fails it. So we go through the test. Test 1, 2, 3 doesn't work. Test 4 comes around. We learn about the more than 50% to less than or equal to. That's obviously not applicable here. So you're wondering, okay, well, isn't this distribution? We have another issue, though. Look at Orange. Before the transaction, think about this. There's a total of 100 shares of stock. Orange can team up with any owner. So if Orange and Lime are together, 28 plus 20 plus 25 is 53. Orange and Lemon is 52. And then Orange and Cherry is 51. So if Orange teams up with just one owner, that two control the corporation. Going back to our decision, right? Retail versus online. If Orange could persuade just one owner, doesn't even need two or the three other ones, just one. Orange will control with that person. Versus if any other shareholder tried to do that, the only person they could control with is Orange. Because look, Lime plus Lemon is 49. Lime plus Cherry is 48. Lemon plus Lime is 49. Lemon plus Cherry is 47. Cherry plus Lime is 48. Cherry plus Lemon is 47. But if you add them with Orange, you can control. Everyone see that? So before, we call this the concert issue. If Orange teams with one person before, that group has control, which honestly probably isn't that difficult to do, right? Your chances are not that bad. One out of three. 1/3 chance you can persuade them. Now, if Lime, Lemon, and Cherry all get together, 3 people, they're gonna have more than they're gonna have control. But the chances of that, all 3 people getting together when they're unrelated versus just Orange and one of them getting together is less, probability speaking. So before, again, Orange has the ability to control before. Now, you're wondering about the percentage, 22.6. So if we were to redo this chart, and I'm not going to do it with you, you could do it at home, you could try it yourself. If we were to redo this chart where we did orange 21, lime 24, or lime 25, lemon 24, and cherry 23, what you'd see is that now lemon cannot team up with anybody. Lemon has to team up with, I'm sorry, not lemon. Oh, I keep saying lemon. Orange now cannot team up with one person. They have to team up with at least two people. So orange loses that ability to team up with one person. Now, after orange needs two other owners. To control. So, if this happens, the tax law says this will be treated as a NEED, not essentially equivalent to a dividend, and therefore will be treated as a sale or exchange. Now again, this is going to be a very unique fact pattern. So if I give this on the exam, you're going to see it's going to be set up kind of similar. So you need to be thinking about that issue. But the most important thing is understanding how this works. Because if you see what's going on here, again, the best way to do is picture a decision that the corporation's making that's so integral that the voters only can decide, the owners. Like, okay, we're going to close our retail and we're going to go 100% online. Or close our brick and mortar, I mean. They have to vote on it, right? And if orange wants to close, lemon and lime don't want to close, but cherry's on the fence, orange might be able to persuade cherry. And that's before it would work, if orange could persuade cherry. But afterwards, if lemon and lime are on the fence, orange and cherry, or cherries, lemon and lime they don't want to close it. Cherry's on the fence, orange does, orange can't do it anymore. Because at that point, you got an issue. So that means, since it's NEED, it's going to be the amount realized minus adjusted basis. Amount realized here is $7,000. Adjusted basis is going to be 7 shares times 900, $6,300. So we have what am I thinking? $700 capital gain, is that what you got? 700 capital gain. And then the adjusted basis per share changes. It changes to okay, you take the total basis given to you, which is 25,200. Oh, my apologies, you're right. We don't. That's for distribution. See, I just caught myself. No, it does not change. It stays the same. Good catch. It stays the same, yes. So it's still $900. I was getting ahead of myself there. Again, if it's a sale or exchange, the adjusted basis, the remaining shares, it stays the same as it was before. But if it's a distribution, it changes. So thank you for correcting me on that. You can use our little eraser here and right, change that out. Okay, so that's D. So let me pull out that question again. Move that down and we can do E and we'll be done with this topic. So we have E left, and that's it. So in E, Fruit Loop redeems 5 shares from cherry. So we haven't yet had a problem with cherry. We've had one of orange, lemon, lime, now we have cherry. Cherry, who's lime's brother. Cherry is lime's brother. For $5,000. Shareholders are otherwise unrelated, and then cherry's basis in her stock is $900 per share. Okay, so E, again, we go to NEED because if you go through the other tests, they would fail. We've got before and after. So the before, we have to take into account any direct and indirect ownership. Now, we are told that Cherry is Lime's brother. But for purposes of the related party rules, which this is on the checklist, it's on the attribution rules. And I showed you, remember the family attribution? For purposes of attribution, a brother-sister relationship, or brother-brother, or sister-sister, is not considered related. You attribute the stock of your parents, your children, your grandchildren, your spouse. That's it. Nothing else. So you do the person that's being redeemed. If your parent has any stock, you add in. If your children have any stock, you add in. If your grandchildren have any stock, you add in. But a brother or sister doesn't get added in. So that means there's no indirect ownership here. It's just going to be the 23 shares before out of 100, so 23%. And after is going to be, what is that? 23 minus 5 is 18 over 95. What's that equal? 18.9. Thank you. So you're looking at this and you're saying, okay, it can't be the 50% test, and you're right, because for that test to apply, you have to be more than 50% before, direct plus indirect. So that test is not going to be relevant. So the only other possible test is the concert test. So you ask, okay, and we can erase if it lets me. Oh, I think it will. Let me see. Nope, I guess it won't. It kept that, it locked it. So we're focusing on Cherry here. And the concert issue deals with teaming up. If Cherry teams up with Lemon, is there control? No, it's 47. If Cherry teams up with Lime, is there control? No, it's 48. Orange, this is 28 shares. 23 plus 28, if Cherry, C plus O team together, we've got 51% before. Okay. If we go 28, 25, 24, 23, I'm sorry, my apologies. 18. 18 after. So Cherry has 18 shares after, right? That's after E. Orange has 28, Lime has 25, Lemon has 24, and Cherry has 18, not 23. So that was before C plus O. C plus O after. 18 plus 28 is what? 46? 46 divided by 95 is how much? 48.4%. So the question is, if a shareholder goes from being able to control with one shareholder, even if it's a specific one, to not being able to control with anybody, which is what you have here. Because if you did the calculations right, 18 plus 28 is 46 over 95, 48.4. It's going to be less than 48.4 for everybody else. You're going to be 18 plus 25 is 43 over 95. That's going to be less than 48.4%. So nobody you're going to be able to control with. So you go with, hey, controlling with one specific to no. The question is, does the concert rules that we just talked about, does that apply? And the answer, the rules say yes. This is treated as NEED. And therefore, it's a sale or exchange. And we're going to do amount realized minus adjusted basis. So we take our amount realized, which is $5,000. Adjusted basis is $900 per share, so that's 5 shares times $900 is $4,500. We have a 500 capital gain. And then again, just like last problem, the adjusted basis per share stays the same. So that equals $900. And we're done with with redemptions, distributions, all of Module 8.